The fourth statement that would be included in the annual report is the statement of cash flows. And the statement of cash flows is broken down into three sections. The top section is always operating activities. And this has to do with the direct activities of the company to make money. So what does this company do? In the case of De Leon, it sells snack food. So what we see in the operating section all has to do with the selling of snack food. So the top line is always the net income of the company. And so we have recorded on our income statement a loss of $160,176. We are trying to determine how did our cash change. And embedded in our net income, if you recall, we'll go back and take a look. Is a subtraction for depreciation and amortization. And as I mentioned at the time that we covered that, that is not a cash expense. That is an amount that the government allows us to write off to reduce our income and to recognize the fact that the assets that we purchased previously are no longer as valuable as they were when they were first purchased. So we did not have a cash expenditure, but it is in this negative $160,176. So we are now going to add that amount back in so that we only look at the cash change based on net income. The next four items are the increase in accounts payable, accruals, accounts receivable, and inventory. What we need to do is analyze from the balance sheet all of our current accounts except for cash, because cash is what we are trying to explain, and figure out whether or not the change in those accounts either provides additional cash to the company or takes away cash from the company. And the simple rule is that any change in a current asset that increases the current asset is taking away cash. If you think about accounts receivable and that went up, did that give you cash or take away cash? Instinctively we say, well, that'll give us more cash because we have accounts receivable that turn into cash, but they haven't turned into cash. And so what you look at in accounts receivable is money that customers owe you because you have purchased goods and turned them into a snack food, but they haven't paid you yet. So you have that money in accounts receivable, but you do not have the cash. When you look at accounts payable and that went up, you think, well, that's going to take away cash from the business, but it doesn't. It's the opposite. This is money that you owe to your vendors for buying things from them, but you haven't paid the cash to them yet. So when I look at these amounts, we'll just take a look at accounts receivable. We have listed here a positive $378,460. And we'll go back and we'll take a look at the balance sheet, and we see that accounts payable was $145,600 and is now $524,160. It went up, so therefore we are really receiving cash from our vendors by not paying them bill. It is allowing us to keep the cash in the business. So I take a look at the difference. I take the $524,160 and I subtract $145,600, and that's where you see the number here on the statement of cash flows. This is that difference, $378,560. The same applies to accruals. So again, accruals went up. Accruals were $136 and are now $489,600, and I do that subtraction, and the difference is $353,600. Accounts receivable and inventories both went up. And if I go back and I take a look at my balance sheet and I subtract the differences here, we have this much more cash invested in accounts receivable, the $632,160 minus $351,200, and in inventories $1,287,360 less $715,200. So that difference then is reflected on the statement of cash flows. We add those numbers together, and those numbers then give us the net cash provided by operating activities. The second section on your statement of cash flows is your long-term investing activities. And investing tends to make us want to think about things that have to do with stocks, but these are the investments we make in the long-term assets of the company. and that's primarily our property, plant, and equipment, or our fixed assets. And if we spend money and increase those, then it takes cash out of the business. If we sell some of those off, then that would provide cash in the business. And what we have is a difference of $711,950. And this is reflecting the fact that this business was expanding. And when we look at the balance sheet under assets, we see that our fixed assets have grown from $491,000 to $1.2 million. The number that is reflected on statement of cash flows is from the gross fixed assets, not the net, keeping in mind that depreciation and amortization is in a separate line item. So the difference that you're seeing is the $1.2 million minus the $491,000. The final section is financing activities. And so all those things that have to do with debt and with the common stock of the company, the bottom portion of your balance sheet, are reflected in the financing section. So again, we had an increase in notes payable and an increase in long-term debt. We borrowed money. We borrowed money from the banks with both notes. Here is reflecting the $436,808. So these are short-term payments that are due within 1 year, and then the long-term debt. So we took on some longer-term debt of $400,000. And then finally, the last thing was actually noted on the income statement, and that was the amount of dividends of 11 cents on 100,000. So you see those three things at the bottom of the financing section. Increase in notes payable, increase in long-term debt, and the payment of the dividends is taking away cash. So we have $825,000 positive. So the net decrease in cash, if we add the three sections up, the negative $164,176 on operating, negative $711,950 on investing, and a positive $825,808 on financing, we end up with a net decrease in cash of $50,318. We combine that with where cash was at the beginning of the year of $57,600, and we can then check on the balance sheet and see that that does indeed match the $7,282 that we had at the end of 2012. So we see it in both places, the very bottom of the statement of cash flows and in cash on the income statement or the balance sheet.